Bloomberg admits the crash is happening. Sell now. The crash is here. Bloomberg finally admits it. Markets are collapsing and Wall Street experts are panicking. After months of denial, Bloomberg has confirmed what many feared. We're on the edge of a financial collapse that could make 2008 look like a mere stumble. Are you prepared for what's coming? Or will you be one of the millions of victims who lose everything? My name is Julia and welcome to Market Pulse. Let's get started. For months, the major financial media have been sugarcoating reality. Optimistic headlines, superficial analyses, and wishful predictions have dominated the front pages. But now, Bloomberg, one of the giants of global financial information, has broken the silence with a series of devastating reports, confirming what the savviest investors already knew. The market is on the brink of collapse. In its latest report, titled "This Key Stock Market Indicator is Flashing Red," Bloomberg admits that a key stock market indicator has entered a phase historically associated with the worst return prospects for the S&P 500 index. This isn't a simple correction. It's not passing volatility. It's a clear signal that collapse is imminent. A stock market indicator has entered a phase historically associated with the worst return prospects for the S&P 500 index, warns Bloomberg in its May 9, 2025 report. This isn't a statement made lightly. It's an admission that current market patterns are identical to those that preceded the worst financial collapses in modern history. And it's not just an isolated indicator. Bloomberg also published The Financial Crisis of 2025, Better to Be Ready, where it openly acknowledges that a financial crisis is not out of the question and that policymakers must be prepared for the worst. When a media outlet like Bloomberg starts talking about preparing for the worst, it's time to pay attention. Trevor Genowayne, a financial analyst quoted by NASDAQ, confirms. The forecasting model currently suggests that U.S. GDP fell at an annualized 2.2% in the first quarter of 2025. GDP has contracted at an annualized pace exceeding 2% only during two periods over the last 20 years. And those two periods were precisely 2008, 2009, and 2020, both marked by devastating recessions and market collapses. What has led Bloomberg to finally admit the truth? The signals are so evident they can no longer be ignored. The stock market has experienced its worst day of the year, with the NASDAQ 100 index plunging 3.8% and the S&P 500 index sinking 2.7% in a single day, as reported by Bloomberg in March. But this is just the tip of the iceberg. The real catalyst came on April 25, when global stock markets crashed amid increased volatility following the introduction of new tariff policies by the United States president. This event, documented in Wikipedia as the 2025 stock market crash, triggered widespread panic selling that caused markets to lose over $6.6 trillion in just 2 days, the largest two-day loss in history. In 2 days, the Dow Jones Index lost over 4,000 points, 9.48%, S&P lost 10%, and NASDAQ lost 11%. $6.6 trillion was lost, the largest two-day loss in history, confirms the historical analysis. This period was also the first time that the Dow Jones Industrial Average shed over 1,500 points consecutively over multiple days, and the worst ever two-day period for the S&P 500. Bloomberg also notes that the VIX, known as Wall Street's fear gauge, spiked 15 points to close at 45.31 points, the highest close since the 2020 stock market crash. When fear dominates markets at these levels, history teaches us that the worst is yet to come. And as if this weren't enough, Bloomberg also warns in Stock Rout Picks Up Steam with Recession Warnings Blaring that the U.S. equities market experienced its worst day this year, and that recession warnings are blaring. When Bloomberg uses terms like warnings blaring and worst day, it's sending a clear message: prepare for disaster. To understand the gravity of the current situation, we must compare today's indicators with those of the 2008 financial crisis, and the similarities are terrifying. In 2008-2009, annualized GDP fell 2.1% in Q3 2008, 8.5% in Q4 2008, and 4.5% in Q1 2009. As the financial crisis hammered the U.S. economy, banks were often unable to lend money to businesses. and consumers saddled with mortgage debt spent less on goods and services. Those events led to the Great Recession, during which the S&P 500 fell 57%. Now, in 2025, the forecasting model from the Federal Reserve Bank of Atlanta suggests that U.S. GDP contracted at an annualized 2.2% in the first quarter of 2025. And according to historical analysis, whenever annualized GDP has contracted by more than 2% in the last 20 years, the U.S. economy has suffered a recession, and the S&P 500 declined by an average of 45% during those periods. But there are factors that make the current situation potentially more dangerous than 2008. 1. Unprecedented debt levels. Both public and private debt have reached historic levels, limiting the response capacity of governments and companies. 2. Global trade tensions. Aggressive tariff policies have triggered a trade war that is paralyzing global trade in a way we didn't see in 2008. 3. Multiple asset bubbles. Unlike 2008, where the bubble was primarily in the real estate sector, we now have simultaneous bubbles in stocks, bonds, real estate, and even cryptocurrencies. 4. More interconnected financial system. Financial globalization has created a system where problems spread faster and with greater impact than in 2008. As the Streets article, How 2025's Debt Crisis Compares to the 2008 Crash, points out, experts warn that rising debt and high interest rates could spark a crisis like 2008, or worse. This, or worse, is what should keep us up at night. The most alarming aspect of Bloomberg's recent publications is their tone of resignation. In No Relief for Stocks as Risks Mount to Economy, Bloomberg admits that stocks are falling further, adding, to losses following a $2.5 trillion wipeout in U.S. equities. There's no optimism, no buy the dip, no this will pass soon, just the stark reality of a market in free fall. And in Trump Takes a Wrecking Ball to Wall Street, Bloomberg acknowledges that stocks are getting crushed by recession fears, with the S&P 500 falling 9% this week. When Bloomberg uses terms like wrecking ball and crushed, it's abandoning any pretense of optimism and admitting the gravity of the situation. But perhaps the most revealing admission comes in the form of historical comparison. Bloomberg is now openly comparing the current situation to the 1929 crash, one of the most catastrophic financial events in history. In How Liberation Day Rout Compares with Other Notorious Stock Market Crises, it notes that a rapid $4 trillion loss in global stock markets has led some to compare Trump's trade war with the 1929 Wall Street crash. When a financial media outlet of Bloomberg's stature starts making comparisons to 1929, it's sending a clear message. This is not a normal correction. It's not passing volatility. It's a historic event of catastrophic proportions. And most revealing is that Bloomberg now admits that investors who feared an imminent stock market collapse were right. In The Stock Market's Fear Gauge is Misunderstood, Bloomberg acknowledges that, as we now know, investors' fear of an imminent stock market collapse was well-founded. This is a direct admission that the collapse is not just possible, but already underway. Despite these alarming admissions, there are aspects of the crisis that Bloomberg still isn't openly discussing, probably to avoid triggering mass panic. But as smart investors, we must read between the lines and prepare for what's coming. First, the real magnitude of potential losses. If we follow historical patterns, and as Bloomberg itself has pointed out, when GDP contracts more than 2%, the S&P 500 has fallen by an average of 45%. But given that we're seeing multiple simultaneous bubbles and unprecedented trade tensions, the losses could be significantly greater, potentially exceeding 60%. Second, the duration of the crisis. Bloomberg talks about the fall, but not about how long the recovery might take. After 2008, it took more than 5 years for the market to recover to pre-crisis levels. With the current aggravating factors, we could be talking about a lost decade for investors. Third, the impact on specific sectors. Some sectors will be hit much harder than others. Technology, which has led the bull market, could see declines of more than 70%. Commercial real estate, already weakened by the pandemic and remote work, could experience a total collapse. And the banking sector, exposed to both, could face an existential crisis. As Nasdaq's analysis notes, the Russell 2000 led losses by falling 6.59%, entering a bear market. This indicates that smaller companies are already being devastated, a pattern that typically precedes broader falls across the market. And finally, the impact on personal wealth. Bloomberg barely mentions how this crisis will affect individual investors, retirees, and pension funds. The reality is that millions of people could see their retirement savings halved or worse, creating a retirement crisis that will last for generations. Based on Bloomberg's admissions and historical patterns, there are certain assets you should consider selling immediately before losses accelerate. 1. Overvalued tech stocks. Technology companies with stratospheric valuations and minimal earnings will be the first to fall. Bloomberg has already noted that the Nasdaq has been the hardest hit index, falling 3.8% in a single day. Companies like Tesla, Nvidia, and other tech stocks with extremely high price-to-earnings ratios are particularly vulnerable. 2. Commercial real estate. With remote work here to stay and interest rates rising, the commercial real estate sector is on the brink of collapse. Bloomberg has reported on market volatility that's already worsening the housing shortage, indicating fundamental problems in the real estate sector. 3. High-yield bonds, junk bonds. Bloomberg warns about bond vigilantism, where bond markets experience widespread selling. High-yield bonds, which are already under pressure, could see dramatic falls in value. 4. Regional bank stocks. Smaller banks, exposed to both commercial real estate and consumer loans, could face a liquidity crisis similar to 2008. Bloomberg has noted that rising debt and high interest rates could spark a crisis like 2008, or worse. 5. Emerging market ETFs. With trade tensions rising and the dollar strengthening in response to the crisis, emerging markets will be hit hard. Bloomberg has reported on retaliatory tariffs imposed by China and other countries, indicating worsening trade relations. 6. Speculative cryptocurrencies. While Bitcoin might serve as a haven for some, more speculative cryptocurrencies and NFT tokens will likely collapse when liquidity disappears from the system. Bloomberg barely covers this sector, but history shows that the most speculative assets are the first to fall during a liquidity crisis. 7. Stocks of companies with high debt. With interest rates rising and the economy contracting, companies with weak balance sheets and high debt will face serious problems refinancing. Bloomberg has noted that rising debt and high interest rates are key factors in the current crisis. The key is to act now, before panic becomes widespread. As Bloomberg warns, we're seeing signals that have historically preceded the worst market falls. Waiting could mean catastrophic losses. While Bloomberg rarely makes direct investment recommendations, its recent analyses clearly point to certain defensive strategies. 1. Cash is king. In times of crisis, cash provides both safety and opportunity to buy assets at bargain prices later. Bloomberg has noted that investors are seeking shelter, and cash is the safest shelter in a financial storm. 2. Gold and precious metals. Historically, gold has served as a haven during financial crises. Bloomberg has reported on falling oil prices, but precious metals often move in the opposite direction during systemic crises. 3. Value stocks with solid dividends. Companies with strong balance sheets, stable cash flows, and sustainable dividends tend to weather recessions better. Bloomberg has noted that certain sectors are showing relative resilience. 4. Short-term Treasury bonds. Despite concerns about government debt, U.S. Treasury bonds remain a safe haven during crises. Bloomberg has reported that Treasury bonds rallied, pushing 10-year yields below 3.5% in response to the market fall. 5. Hedging strategies. Put options, inverse ETFs, and other hedging instruments can protect your portfolio. Bloomberg has highlighted the rise in the VIX, indicating that investors are paying higher premiums for protection. X. Defensive sectors. Utilities, healthcare, and consumer staples tend to weather recessions better. Bloomberg has noted that certain sectors are showing significantly less volatility. 7. Geographic diversification. Some economies will be less affected than others. Bloomberg has reported on emergency responses by various governments, indicating that some countries are better prepared than others. The key is to act now, before panic becomes widespread and these defensive strategies become prohibitively expensive. As Bloomberg suggests, it's better to be ready for the 2025 financial crisis. The most uncomfortable truth that Bloomberg is finally admitting is that this time there will be no easy bailout. In 2008, the Federal Reserve and the government intervened massively to stabilize markets. In 2020, we saw unprecedented stimulus, but now, with inflation still elevated, public debt at record levels, and political tensions at their peak, rescue tools are severely limited. As Bloomberg notes in The Financial Crisis of 2025, Better to be Ready, policymakers must be prepared for the worst, but their ability to respond is constrained by current economic and political realities. Additionally, Bloomberg now acknowledges that current market patterns are identical to those that preceded the worst financial collapses in modern history. And this key stock market indicator is flashing red. Bloomberg admits that a key indicator has entered a phase historically associated with the worst return prospects. And perhaps most revealing is the admission that the market has entered correction territory, with the S&P 500 falling 14% from its high. Historically, when corrections coincide with GDP contractions exceeding 2%, as we're seeing now, the result has been an average 45% decline in the S&P 500. The conclusion is clear. Bloomberg is finally admitting that we're on the brink of a historic financial collapse, and this time, there is no safety net. Bloomberg has broken the silence and admitted what many feared. The crash is here, and it could be worse than 2008. Key indicators are flashing red, historical patterns are alarming, and rescue tools are limited. The time to act is now, before panic becomes widespread and exits become congested. Sell high-risk assets, increase your defensive positions, and prepare for what could be one of the most severe financial crises in modern history. As Bloomberg itself has noted, it's better to be ready for the 2025 financial crisis, and being ready means taking decisive action now, while there's still time. Don't wait until it's too late. Don't wait until Bloomberg admits the whole truth, because by then, markets will have already completely collapsed. History has shown time and again that those who act first are the ones who best survive financial crises. The crash is here. Bloomberg has admitted it. The question is, what are you going to do about it? Thanks for watching. If you found this helpful, hit that subscribe button and hang out with me here on Market Pulse every week. See you in the next one.